At the December board meeting today, the Governor and the board has kept the cash rate on hold at 1.5%. Now, this is the 16th consecutive month that we've seen the cash rate remain on hold at 1.5%. Now, the big news has been around the announcement of a Royal Commission into the banking sector to try and sort of bring a bit more transparency into what's happening in the banking sector. Personally, I think it's a political stunt. I don't think that we'll get any further value out of it that we weren't already going to get out of the inquiries. But the fact of the matter is, it's been announced and it's happening, so we'll see what comes of it over the next 18 months as the Commission takes shape and we start to see some of the findings come through. Okay, now let's talk about the cash rate and why there's now why there might be some pressures on the rate rising versus the rate remaining where it is. So firstly, the argument for a rate rise are these. That the overall business conditions have improved. So we're seeing business sentiment, business confidence, and also business spending start to increase. Now that's a positive sign because we've been talking about this for a long period of time. As we transition from the mining boom, we needed to see more of that investment coming in to non-mining sector, and that's starting to happen. We also see a fairly big program of infrastructure spending around the country, and that's all good as well. Now that flows into jobs, and we've also seen a positive number around unemployment. So the unemployment number's been going down, and that means that obviously more people are being gainfully employed. Now, we talked about the capacity before, so the spare capacity in employment. We're starting to also see more full-time jobs being created. So these are the signs that the Governor and the board are basically need to be sort of focusing in on, and that's why they're starting to maybe push the argument higher. Now, if we overlay that with their forecasts around GDP, in other words, how strong the economy is growing, into late 2018 and 19, they see the economy picking up. So that's potentially going to be their argument to push the cash rates higher. Remember, 1.5% cash rate is what they consider emergency levels. So it's important to understand that they would love to lift it a little bit higher so it gives them some flexibility in the cash rate lever. But that's where we sit right now. Now, the reason why they haven't been moving is there's still some problems. There's still some issues that they see in the economy. Number one, there's no real justification to raise rates because we haven't seen strong income growth. Okay, so when you don't get strong income growth, you don't get that people being able to spend more. And that is flowing into consumer confidence and spending. So we have seen retail spending, overall consumer spending down, and general consumer sentiment a little bit softer than we would like to see it. So this Christmas New Year retail period, this Christmas spending period is going to be important to see that data coming through in February and March to see whether there's going to be any changes. We've also seen that they've been able to move in terms of cooling the housing market. So the macro-prudential changes that have been made are definitely having an effect in terms of demand on house prices. So we've seen house prices now starting to cool, and in some markets like Sydney, we've seen some small corrections so far. We might see some further correction in the Sydney market as we move into next year. And the final piece of the puzzle here that's sort of challenging for the RBA is around the Australian dollar. Now, the Australian dollar is still stubbornly high, sitting around that sort of 75, 76 mark. We'd love to see that down around the 70-cent mark because obviously it's good for our exports. And if we put interest rates higher, then it pushes the Australian dollar higher as well. So that's why we're not necessarily seeing the RBA pushing the button on the cash rate. So there you have it. The cash rate will remain on hold for the end of this year and potentially into the second half of next year. And that's when we'll start to look at those other economic drivers. So those big drivers around business. If they get those right, we see the inflation start to rise. We see obviously, income start to grow as well. Then we'll start to see that imbalance and they'll potentially pull the trigger where they're more confident in the overall economic story. So before I leave you, happy Christmas and a happy New Year, and make sure you stay safe over this period and get around the family and friends and spend some quality time with them. Thanks for watching.